Yeah, so we can start, Sanjana, now.
Okay,
Quite
great.
a lot of people have joined us in, so
Okay.
you can start with a quick intro.
Okay. So congratulations to all the qualifying teams and Merry Christmas. I'm so sorry we have such a boring subject to discuss just before the holidays, but I think it's very useful and I'm going to try and make it as effective as I can. So just to quickly give you a sense of how we're going to have our conversation structured over the next 45 minutes. I'll just do a 2-minute recap of the last discussion I had about legal structures, which flows into the choice of term sheet. Talk about what a term sheet is, and then based on like conversations with, of course, the global shapers and several entrepreneurs, we've identified the most sort of mystical terms in a term sheet, and I'm going to attempt to demystify them. And then quickly talk to you about grant agreements for nonprofit organizations and what those look like. Just from the context of when you're thinking about a term sheet, the term sheet can also be for not for profit. And then we'll get questions for about 10 minutes of whatever time is left over. And of course, you're always free to write to me and ping me for anything you have a concern with. So, any questions right now, or can I just jump right in? Okay, so I'm just going to go for it. So, based on our last discussion, just very quickly, in India, most social enterprises register under three broad structures. One is, of course, non-profit or public charitable organizations registered under the Indian Trusts Act of 1882, or a Section 25 company under the Companies Act of 1956. Of course, the benefit of this is that you're a nonprofit organization, and so the money you raise will come primarily from donors, institutional and non-institutional, and your funding is subject to tax benefits and deductions. The other type of model for social enterprises and mission-driven organizations, which is very popular, is the for-profit private enterprise. And more than 80% of social enterprises in India today structure themselves as profit private limited companies. And there are several examples: Vatsalya, Healthcare, Ujjivan Microfinance, Delight, to name a few. And the third model, which is gaining popularity, is the hybrid model, wherein a non-profit or a for-profit organization identifies a part of their model which is monetizable and then spins it off into a separate organization. So they hive it off into a new business. And examples of that are, of course, as Mohan pointed out in our last discussion, SKS Microfinance or Head Held High Foundation, which has the non-profit which does training for rural youth, and then the for-profit arm of the company which does distribution services for healthcare and a whole other bundle of activities. So in thinking about today's discussion, we thought about there are different kinds of term sheets based on different stages at which your company is. And we made the assumption that since most of the participants are product companies in very early stages, our talk today is geared around term sheets for angel round or early investors or seed money. And I make this assumption based on the fact that many of you are still also in the process of identifying your product market fit. And it'll take you about 6 months for you typically to build enough momentum to raise a larger round, in which case your term sheet will vary slightly. Not too much, but just slightly. So before we begin, there's three little bits of advice that we wanted to give you. So first is to figure out your valuation. I'll talk more about that later, but this is something you need to learn how to do very fast. The second is you need to learn how to make your own term sheet. And the third is when both figuring out your valuation and building your term sheet, you need to ask for what you want, not for what the financier will give. Because it's very tempting to say that, oh, I know this investor who's willing to give me so much, and so I will tailor make both my company's growth strategy and term sheet to fit that. And that's never a good idea, both for the investor and the entrepreneur. Okay, so first things first, how do you value a company? So this is something you have to do intuitively, and there is no, this isn't a science. For most companies such as yours, which don't have traction at the moment and which are product companies, an investor is looking at three broad things. One is if the composition of the team. Are you formally entrepreneurs? Do you have a strong academic or work experience background that adds value to your product? The second thing they look at is what kind of market you're in. If you're in a hot segment, so healthcare is very hot now in India. The investments have been successful. So typically that's the kind of investment an investor would chase. And the third is, of course, traction, which is essentially means if your business model is already proven and you already have shown revenue, or your product is very easy to raise money or return rather. And in that context, valuation boils down to if you're familiar with playing cards, holding high cards, an investor will always back someone who sort of ticks off these checklists. So when you value your company, a resource that is very recommended is, of course, Angel.co, which is the startup database in the US, which companies all over the world use because it's data sheets on performance and valuations, and then gives you a sense of, at the stage of growth of your company, how much can you value it for. And valuation is very, very important because it sets the tone for all the investments you will raise going forward, as well as for this equity you will dilute to your investors coming on board. Just to get a little term out of the way, you'll hear the word round a lot. And I had no idea what that meant as well. And I learned round is essentially like the financing event. And typically, financing events are termed as angel rounds, which are angel investors. They're called angels because they give you godsend money, apparently. And then you move on to a seed round, which is a slightly larger round. So angel investments are sub 2 million in the US, and in India they are sub $50,000 to $80,000. Seed money can go anywhere sub 4 million US. And then you have series A, B, C, and progressively go like a mezzanine level, and it goes forward like that. So please interrupt me if I'm going too fast. Okay. So I think the next logical step is just to tell you what a term sheet is essentially. So a term sheet is just a bullet point document which outlines the material terms and conditions of the business agreement you enter into with an investor. And in the context of this discussion, it's basically financing for your startup, and it includes terms like around the amount raised, pre-money valuation, liquidity preference, voting rights, anti-dilution provisions, rights of refusals. All of this I will explain. But these are like the key things included in your term sheet. And the goal of the term sheet is essentially to protect both the investor and the entrepreneur, and also to support the company's growth. That is to help add on more investors and help attract talent as well. And I'll tell you how that happens in a bit. While there's a lot to negotiate in a term sheet, it's actually non-binding legally, and it's simply a step to an actual deal, and it is subject to due diligence. So things you commit in your term sheet aren't necessarily set in stone until post that a due diligence of your balance sheet and financials and references is complete. So that's something you need to also remember. There is a tendency to assume that if you get a term sheet, it means you have money in the bank. You don't have money in the bank until you actually have money in the bank. But it's a key step, and it shows a lot of confidence from an investor, and it's definitely a good sign. Okay, so to start with, the first term you will see in your term sheet is pricing, and this is the most challenging part for an entrepreneur. And because there's, of course, pricing of your company, and there's essentially two categories of pricing that you need to know about. So one is pre-money, and this is the company's value before the money from a raise. And then there's post-money, which is the pre-money value of the company plus whatever cash is added. So just to give you an example, let's say a company is valued at 4 million pre-money, and additionally raises 2 million from an angel investor, then its post-money value is 6 million. It's pretty straightforward. Just in case you're wondering how the pre-money value is established at 4 million, this is what you need to do and what I mentioned earlier about valuation. So pricing is essentially just pre-money plus and post-money, and then of course it changes round to round. And then the next clause that you will see, which is important and harder to understand, is your liquidity preference. So there's essentially a liquidity preference is talks about the stock available for an investor in your company. And there are two types of stocks typically issued: common stock and preferred stock. There's actually preferred participation stock and some more complications to this, but just for the sake of one, keeping in mind that this is an angel round, and two, of course, given the assumption that many of you are first-time entrepreneurs, this is possibly the most simple term sheet terms to understand. So what is preferred stock under liquidity preference? So preferred stock is essentially a clause where an entrepreneur has the right to, or rather an investor has the right to access or sort of apply a return on their initial investment over another stockholder, a shareholder rather. To give you an example, so let's see. So if you go, so if a company is valued at 2 million, on which 1 million was the initial investment from the investor, so he owned 20% of the company, and he had a 1x liquidity preference. That means one-time liquidity preference. It means he gets 1 million back. Now you're thinking about what is this 1x, 2x, 3x. The reason I'm bringing this up is this is how many companies die, because sometimes there can be a clause in your term sheet that you don't see, which essentially says that the investor has a 2-time liquidity preference or even 3 times. And essentially what it means that if an entrepreneur puts 1 million, he gets his 1 million back, and additionally he gets 2 times of what the round is closing at. So this can mean that there's very little left for the second type of stock, which is common stock. And common stock is what's given to employees, and we'll talk a little bit about that later, but that's essentially for both for the hiring purpose and then for follow-on investors, etc. Just to also clarify this, if none of this makes sense, just remember 2 things. Preferred stock is for investors, common stock is for employees. And this, when you look at your term sheet, this will help you understand a little bit about where the thought process about structuring it is coming from. Now, typically, the sort of industry standard now is like almost 80% of investors, including angels, they take a 1x liquidity preference, which is the most fair thing to do. That is, they just, when at the time of liquidation, they just get what they've invested. So I think that's straightforward, and once you read a little bit more about it, it becomes more intuitive to understand. I know this is a bit abstract at the current moment. So the next thing, I mean, in following this, there's another term which you will see in your term sheet called option pool and anti-dilution. So when you raise a round, you have the option to, you can create an option pool. And what this means is, this is a portion of your equity that you set aside later to incentivize future employees. So let's say you are 2 founders and you own between yourself, let's say 30% and 40%. And so you have, between the 2 of you, you own 70% of the company, and then you leave 10% aside, or 15% up to 5% most of the time for your employees. And why this is important is, let's say both of you are in product and you're looking to hire a CEO, CTO, CFO, and early stage startups typically don't have the financing to pay very high market salaries and attract the best talent. And so they offset this sort of flaw by giving stock options. And the stock options come from this pool. Um, Now, option pools, obviously, they vary depending on the size of your company and what stage you're at, etc. But for startups and in the healthcare space, it can be anything between 10 to 18% of your post-money valuation. Um, so that's what an option pool is. And what anti-dilution essentially means is that it's sort of a clause to help an investor um, as your company grows. So down the line, as you raise more and more money, an investor runs the risk of getting diluted. So they generally add an anti-dilution agreement in their term sheet. And so this means if they sell stock in the future for less than what was sold to them, they will get issued more shares for free. So effectively giving them the same price as a new investor. Now, this sounds a bit complicated, but it's important to internalize this simply because it means that if this clause is in your term sheet, you stand to lose more stock as opposed to if it was not there. And in most cases, anti-dilution need not be in your term sheet. As a caveat, I feel like I need to tell you this. For inexperienced entrepreneurs, overzealous lawyers can be probably the most dangerous thing. Um, for startups, even in India, startups get charged legal fees between $5,000 to $7,000 just to structure shareholder agreements, term sheets, and employee agreements. All of which actually you can do yourself and get supported by with a lawyer. I will also share those resources with you for sample term sheets, etc. But coming back to the terms, so just to recap what we've talked about so far. So we talked about what a term sheet is. It's just a document outlining the material terms and conditions of your agreement with an investor. We talked about pricing, pre-money, post-money. We talked about liquidity preference, which is preferred stock, which is primarily for investors, and common stock, which is for employees, future shareholders, etc. We talked about an option pool, which allows you to put aside equity for future employees, and anti-dilution, the idea of sort of vesting investors with more stock as your company grows. So the fifth term I want to talk about is vesting. You'll hear this term a lot as an entrepreneur, and vesting is simply put is the process by which like an employee earns access to their shares, and it's typically used as an incentive to get employees to stay in your organization, especially senior employees, to stay and grow the organization. And so it could mean an employee gets access to their stock at the end of a year, end of 3 years, end of 5 years. And yeah, that's essentially what it is. Even founders get vesting schedules after taking out their investments. So even a founder, as you raise more and more rounds, they earn equity over time based on these schedules. Now, there's another term, tricky term, which has lately been sort of making its appearance in a lot of angel term sheets. It's the right of first refusal, ROFR. And so essentially it means that if a founder ever wants to sell any of their shares to a third party, the right of first refusal requires them to give the company or the investor or the angel the first opportunity to purchase the shares on the terms offered by the third party. And if the investor doesn't exercise its right, then the opportunity to purchase the sort of the new party then gets to purchase the shares. So it's interesting to make sure that if you have a ROFR in your term sheet, you make sure you have it with you make sure it's because there's an experienced investor on board, and not with someone who's investing for the first time. And the same goes with the next term I'm going to talk about, which is information rights. So many a times your investors, say you have 7 or 8 investors in your round. In your angel round, it's quite likely that you'd have up to even 10 investors putting money. And if all of them say they want information rights, it could mean a whole lot of administrative hassles for you, and I'll tell you why. Information right essentially gives an investor the right to review and ask for your financial statements and perhaps your KPIs periodically. Now, it's a great thing if it's an investor who's very experienced and who can actually add value. But if it's an investor who's never made an investment in this space, then it can also be a problem because they don't understand the business. And then they can kind of nitpick on issues which aren't relevant. Why did you spend money on this? Was this hire necessary? Things like that. So when giving information rights, oftentimes the information rights are given to experienced investors or investors who put in only of larger amounts, etc., so that it reduces the founder's hassle of having to deal with so many people. And yeah, the last term I want to talk about is like a participation right. So, for example, if an investor wants 20% of the company in the form of a preferred stock, it'll receive the amount he will receive the amount he originally invested before any other shareholders are paid. Essentially, it's what I talked to you about earlier about liquidity preference, and it gives the investor the right to double dip, and that's not a great thing. So if an investor has a liquidity preference times one and participation rights, so he gets access to his investment first, and he also gets to sort of exercise his participation rights first, which means before anybody else from the common stock can access their capital, the investor will, and not it's like a double dip, and it's not great for an entrepreneur or a company that's in trouble, and it's viewed generally as a bit of a draconian kind of term. So you maybe want to steer clear of it, but then again, it's subject to your investor. So I don't know if all of these terms are clear, but at least when you look at the term sheet and when you look at a sample term sheet that I'll send you later today, you get a sense of what each of these things mean. And then there's another nasty but important thing I must talk about, which is term sheet manners. And this is the only reason I'm bringing it up is because this happens a lot in India now, and especially with product companies, because product companies are very popular. And so when you get your first term sheet, typically, that is, if you haven't made your term sheet and an investor gives you one, you shouldn't start shopping them around, which means don't take your term sheet from one investor and go to the next and say, these are the terms I have. I'm interested in having you on board if you can do better. The market's small, word gets around. It's not the ethical thing to do. The second thing is there's this tendency when you get a term sheet to just send back your comments or questions and then do this back and forth, and oftentimes it can be seen as very offensive or upsetting because when you tell an investor, I don't want to give you information rights, or I don't want to give you liquidity preferred participation rights. So it's always better to have these discussions face to face. The third thing is really do your research on all the lawyers in this space. Now, typically in India, I was mentioning earlier, you can get charged between $5,000 to $10,000, and at the lower end, $5,000, which is a lot of money for a startup, which is bootstrapping. There are ways to negotiate legal fees, and part of that negotiation, or when your contract with your legal team will be saying that you pay them post finishing your angel round or post closing your Series A. There are several law firms like that in Bangalore who are happy to do that and who are very savvy with doing that. If you're ever raising money in Bangalore, I'm happy to recommend them. But the interesting thing about this is that because legal fees is so high, you can easily and depending on the way you structure your company, there's always mistakes in agreements because you are unsure and you don't know what's the right thing exactly, and the lawyer's making assumptions on your behalf, which is why I'm hoping learning this will actually help you avoid any of those mistakes. And when you see a term sheet, make sure that it's in your best interest as well as the entrepreneur's best interests. So I'm going to quickly just take a break and see if anybody has any questions, and then I'll move on to the next part, just quickly talk about grant agreements.
Yeah, so anyone with any questions, just ask Sanjana.
Okay, great. So moving on to
Sanjana?
yes,
Yeah,
yes,
if nobody has any questions,
yes.
I was just sort of wondering, it's quite complicated, and I'm just wondering at what stage,
Yeah.
and whether there'll be any support from people like yourselves, for people interested in taking this further.
Yeah, so I have some good news. Even to kind of develop this, we had two like serial entrepreneurs kind of give us the lowdown on all the terms you're hearing. Um, and they're also very interested, so very interested in helping you, like on a volunteer basis, review all your term sheets in the event that you need help. Um, and that's one. And I mean, obviously the shapers as well. I'm not the expert, but Harsh is an expert, and so is Amrita. So they'll be happy to look at that. And the second resource is, as I said, we do have legal teams across the country who specialize in startup law, who also have arms that like a CSR within their organizations, and they do pro bono consulting. So in that context, these connections also can be made. Yeah.
But could I just ask perhaps a simpler question is that when is it that everybody needs to start involving themselves with this? Is it something that, at demo day, people now, once they start conversations with people,
Yeah.
that's the point at which they'll need some help?
Absolutely. So the minute you make your demo and you have an investor showing interest to you, the immediate next question they're going to ask you is, so what's your company valued at? And that's when you need to tell them that, my company is valued at, say, $100,000, and here's why. And then give them a term sheet, keeping in mind how much they're putting in. Because if you do not have a valuation and you do not give them a term sheet, it's very unlikely you'll be able to close the investment if it's from an angel. Most of them they work through fund managers, and they don't typically they give you, if they give you a term sheet, it's very one-sided, so it's always recommended you are prepared. And two, if you don't value your company yourselves, you can get taken for a ride. And so that's why you need to start thinking about this now. And I know it sounds a bit complicated, but it'll help you in the longer run, and also help your business stay alive for 6 months, so that when you do go to an investor, he knows you know what you're talking about and you can't be taken for a ride.
Okay, I'm just going to ask a question, to the participants.
Yeah.
Do you have any sort of sense in which you might be able to kind of make a estimate of the valuation of your companies? Just anybody, just to see where you are in this process?
I think this is Sridhar here. I think we will have to look at the market sizing
Exactly.
and then see from market sizing what is the penetration we will expect in the first 1 or 2 years, and then be able to say that we would reach this X top line and X bottom line based on our product costing. And therefore, I expect to come to this top line. I need X amount of money for production, X amount of money for marketing, and X amount of money for people to be on hired. And therefore, I will give X amount of shares for this amount of money, taking my valuation to say this much, maybe a million or whatever.
Okay. So, Netrovan, I have a question. How do you determine the valuation for a pre-revenue stage? And that's where the resource that I shared with you, I'll just put it on the link, is useful to kind of understand what other other startups in the same space are doing. It gives you market information, etc. But at the pre-revenue stage, the key things that investors are looking at is what's the team, because these are like moonshot investors. So what does the team look like? What is the idea? If it has any demonstrated proof of working. They don't care so much about your traction and growth if you're at pre-revenue and a product. Yeah. Yeah. Okay.
Any other questions from anyone? Mohammed, Nekram?
I just wanted to ask, are there any consultants who takes you through prepare the term sheets?
Okay, let's see. There is actually nobody. There's lawyers who will charge you between 5 and 10,000, as I said. But what has happened in the last few years is because there have been so many entrepreneurs like you guys, sort of struggling with legal fees and also being taken for a ride. Companies like Y Combinator, Gunderson Legal Firm, Two Sides of the Table, and several other resources which I'll share have sample term sheets. And these are called like safe term sheets because they are in the entrepreneur's interest, and they're also seen as globally like the standard now for investors, angel investors and entrepreneurs. So yeah, you don't really need a consultant. You have these templates ready, and there's a whole host of resources online that can help you both understand them and then tweak them to what your needs are. There you go.
Hello?
Yeah.
Yeah, thank you for the nice and a little bit fast presentation.
I'm
So
sending the write-up, which will be much clearer, I'm sure.
yeah, for people who are not with the business background, I mean, it takes a little bit time to tune. Anyway, my question is that the evaluation that you make is basically based on, you can base this on your sales in the next 2 years or the added value that you have in your products.
I didn't quite follow your question. Can you repeat that?
Yeah, so when you want to evaluate the company, which basically you don't still have some sale, so you will make an estimation of your sales in the next 2 years.
Yes.
And so the evaluation is based on the amount of sale or amount of the venue, amount of the value, added value.
So the evaluation is based on one, your intuition of how much market share you'll occupy. So as a product company, how much of the healthcare segment, for example, you will occupy and what that means in terms of revenue. So market share, revenue, and growth. Growth can mean different things because, for example, maybe you won't be a revenue-making company for the next 5 years, but you have a huge user base, which means for an investor, you're very attractive to acquire and then integrate with another company. So when you make your sort of valuation schedule and you're thinking about that, you don't have to think necessarily in terms of revenue. It's quite likely you won't make revenue for 2 years, but you have another proposition which is very valuable to an investor. So look at those pieces as well. Will you have a large number of users? Can you piggyback on other product? Is your team fantastic? Because acqui-hires are very popular now, and acqui-hires essentially means that, hey, this team is very powerful. They had a great idea, which didn't really monetize, but the team can be used effectively for this idea, and then your company is acquired. But acquired not for the product, acquired for the team and what you've executed so far. So these are some of the ways that you look at valuation.
Thank you.
Sure.
Okay, I think in a sense, that's quite a useful sort of question and answer. That it may be that if we can have some opportunity for teams to kind of go through a question and answer session, on the estimation, on how to take it forward, on what the options are, and then help them to kind of develop their term sheet.
Yeah.
Um,
So if they're interested, we're happy to get an expert to help them with just how to do a valuation, pre-money valuation for their company. So let us know. Yeah.
okay, thanks. That's a great offer.
Yeah.
This is Sridhar here.
Hi.
Yeah, hi. What should be the minimum term sheet that we should be able to showcase on the demo day?
Manas and Tarun want to answer this?
No, in the all the lists that we wrote here, in the sense that the
Yeah.
liquidity preference, common stock, option pools,
Yeah. So
anti-dilution. Yeah.
I will share with you the safe term sheet, and that's your minimum essentially will require you to have your at the most your pre-money valuation, sort of tentative schedule of how much you want to raise based on your projected growth for the next 6 months to 1 year, and that your projected growth means how many employees you're getting, how many, how if you're going to infrastructure costs, operation costs, etc. And also the other bit you need to have is just a few of the legal stuff in place, so just sort of keep you safe. For example, your participation rights, your information rights. Are those something you want to share with your investors? A bit about governance even, which I've not covered today because it's very self-explanatory. Essentially, do you want your angel investor to sit on your board? Things like that. So I think for your pitch day, it will definitely help an investor be to know how much you value your company at and what kind of raise you're looking at. And the reason it'll help is assuming the investor cannot put that much money in. He knows that, hey, there's this great product company in the healthcare space valued at so much, looking to raise so much. I know somebody else who can do it. But if you go without a number and you don't have a sense of where you're going, then it's harder for him to help you. So.
Yeah, thank you. That's perfect.
Okay, Sanjana, I think what we might need to do is, go offline and sort of come up with what the basics. We certainly hope that people are going to come to this note, and if they're going to talk to investors, if they're going to talk to companies, if they're going to even sort of like talk to other startups who might be interested in kind of joining or kind of considering looking at them, they should have something in place. But I think we need to go offline and more than just a template. Perhaps work with somebody in Bangalore to actually come up with an example, and that we can then help people take forward. So perhaps we'll do this online and then take it on and share it with everyone.
Absolutely. So I'm sorry if I've confused you or sort of. We tried as much to sort of water this down to the most basic sort of useful understanding. But I agree with you. Yeah, we'll get an expert who can probably help everyone draft their own term sheet.
Yeah, I don't think you've confused us, Sanjana. I mean, I'm just speaking for myself here, but I think that it's probably quite a lot. As Mahmood was saying, and others were asking, that there's quite a lot to consider, and I'm not sure that everybody has the ready answers to these questions.
Yeah.
So it is. Yeah.
Just to add to that, I know y'all have amazing ideas, and so the reason it's just useful for you to keep in mind that you need to know this stuff to take your idea to market and raise money. And when we were talking, we realized most entrepreneurs they don't know this stuff until they reach the point where they have to raise money. So try and make the effort to just wrap your head around it and figure it out. So.
Hello, Sanjana.
Yeah, hi.
Hi, this is Gaurav from Team Complete Wheelchair. I just wanted to ask one or two questions. One was like we are supposed to submit our term sheet by 25th of this Friday, basically 25th December. So we'll try to make it as good as possible. But after that, will there be some review of our sheet before the demo day so that we can improve it further going towards the demo day?
Yeah, I suppose, yes, there can be review of all the term sheets. So then I think it will probably be a couple of reviews till you get to your right term.
It might need maybe more than one review, I guess.
That's my sense of it. So yeah,
Okay.
we're happy to support with that process. No problem.
Okay.
And you said any more questions? You said you had a couple of questions.
Yeah, one was the we have been assigned a mentor. He's from Global Shapers Hub.
Okay.
Uh, and regarding which issues can we seek his help regarding this term sheet or some other areas? Like I'm not clear.
So for us internally, the mandate is help with everything. If we don't know what to do, we direct you to an expert externally who we know. So
Okay,
just pick his brain for anything you need, and if he can't answer you, he'll probably bring someone else who can. So
okay,
yeah.
okay. Yes,
Okay.
that is it.
Yeah. Any more questions?
Yeah, so basically something more basic that
Okay.
the basic question that I have is,
Yes.
so basically the angels, you described why they are called angels, but are they real angels or or
Um,
not? So
Very good
basically
question. Yeah. That's
yeah
a good
my yeah, and the second one is that how, so after you basically it is expected that you get some investment and then you raise more money during the next 2 or 3 years. I mean, can you give us some examples to
yeah.
understand the first stage of fundraising and then the second
Sure.
stages and how it's expected to work, please? Thank you.
Absolutely. So one is in terms of are angels really angels? That's subjective, and most of the time they are because they take risks, and the kind of investor you get will direct the trajectory of the remaining funds you raise. Now, in the US, you have guidelines only like accredited investors that are allowed to make investments, and so it means that they can typically participate in follow-on rounds, etc. But in India, we have very vague rules. The SEBI has a couple of circulars out around angel investing, but none of the rules are set in stone and they're very vague. So you have investors from very broad range of sectors, including you can have an angel even from like a sweet shop to an IT company and so on and so forth. They're angels if you know how to structure your term sheets in a way that it benefits both parties, shared value. The second question is in terms of your schedule of raising money. So this is very closely tied with your company valuation and where you see your product going. You need to build after you raise your angel money, you have to typically raise your say seed round or Series A round within 8 to 12 months for a social enterprise, and for 3 to 6 months, or rather 6 to 9 months for a for-profit startup. And this is important because it has a strong signaling effect to other investors. Now, how you decide when you are going to raise your money is based on what kind of growth strategy you have for your organization, which you will chart out when you are defining your valuation. For instance, in 0 to 3 months, you say want to build XYZ. In 3 to 6 months, you want to test and scale your product to so many places. And so that will define your costs. And according to your costs, you will be raising money. The other challenge is as a founder, unfortunately, you will never stop raising money from the minute your first check comes in. You have to build your deal flow, and your deal flow is essentially your list of all your donors, or not donors, rather your investors, um, from an angel round up to your Series B, and you keep having conversations with them to see when they want to invest and when you are ready for them to come in. So that's how it uh, generally this is approached. In terms of a case study of how money is raised, there's very little information on startups in the Indian ecosystem, especially social enterprises. There hasn't been a formula that has worked for anyone. Mostly it's been friends and family doing the first round, then an angel round, and a very long gap between an angel round and a Series A. Sometimes it's been a very short time between an angel and Series A, and then a long gap between a Series B. So unfortunately, I don't have a case study. I recommend reading the Varthana story. I'll just type that in. It's an education startup, and it's interesting to see how they fundraise. There's more information about their fundraisings online, so it might be helpful.
So one more quick question. Basically, I don't understand quite why they are called angels. I mean, what's the difference between an angel and a normal investor?
The amount of investment is small for an angel investor. There is no an angel investor in your at the current stage of where your company is puts in a large percentage of the amount you need to raise. So let's say your company is valued at say 2 million, your angel investor puts 1 million, which is 50% of the value, and then gets maybe 20% of stake. That's how it works. And based on your current legal structure, they're called, that's why they're angels, because they take the risk, so they get higher return.
Anyone with any further questions?
Hello.
Yeah, go ahead.
Sanjana. Yeah, for-profit social enterprise, is it recommended to begin with a limited liability partnership structure or some other structure?
Typically, yeah, limited liability is the private for-profit private limited liability. Yeah, is typically the most common structure. It doesn't matter if as long as you're registered in India. If you're registering your company in, say, Singapore or US, and Singapore usually for tax breaks and US also for tax breaks, then the jurisdiction of where your company is domiciled, that affects the tax laws. But in India, it's pretty uniform, so it doesn't matter.
Okay.
Yeah. Any other questions?
Is there chances that a startup company with basically in the healthcare that is trying to sell product at low prices, I mean, get some donors also to help in the yes?
So I recommend reading the case study of Embrace Innovation. So they are kind of the hybrid model that I was mentioning. They started as a for-profit social enterprise, and then they found that it made sense for them to hive off a part of it and run it as a non-profit. So they have donor money that comes in to fund that part into markets where markets don't exist, or areas where markets don't exist anymore. So yeah, and they are a product company, healthcare product. They make infant warmers at low cost. Yeah. Any other questions?
So it's basically two companies, one non-profit and one for-profit.
Profit. That's right. That's right. It's called the hybrid model. Yeah. And the
Sanjana?
company, yeah, go ahead.
Normally, at the angel round, how much stake is normally like what's the stake that normally angel investors are interested in getting for the angel investment?
This is the $1 million question.
Okay, but normally, is there any like general trend that is for the angel round?
So sadly, there is a general trend, and it's very negatively skewed towards entrepreneurs, but the trend is changing now. Typically, it ranges between 12 to 20%, depending on the sector you're in, which is quite high. So 12 to 20 in India. In the US, it's as low as 4 to 10. And in the rest of Southeast Asia, it's between like 5 and 12. But in India, currently, it's between 12 and 20% for your angel investor in your first round.
Okay.
But
And are there any other ways of raising money, like in some terms of government grants for? Is there any
yeah, of
special?
course. I mean, I'm actually, Nikram is the expert on government grants. You should pick him to give you information on that.
Okay.
But aside from that, there's of course the crowdfunding, which has become very popular. So you can raise your seed capital online. You have a compelling idea through individual investors, so as to speak, donors slash investors. It's a fine, vague line right now. Um, but and there's also depending on which state you're in, like states like Kerala, for example, has Startup Village where they give you free space, incubation, and seed money in their Startup Village. You can look it up for your idea, and this is government funded. And I understand they're replicating this model in several states as well. Ahmedabad also has a very forward state policy for startups. So it's definitely worth exploring that. Several companies have exploited the opportunity in Kerala from startup.
Okay. Are there any specific incubators for social enterprises or for healthcare enterprises? Like,
Yes, so for social enterprises, there's Will Grow, and yeah, there's a bunch of links I can send you, but there's Will Grow, there's let's see, there's the Deshpande Foundation, but that's primarily restricted to Karnataka and investments there. But there's now also the Deshpande Foundation funded by Fanindra Sama, which has just started in Andhra Pradesh, based out of Nizamabad. So that's investors there. He's also a very big investor in the social enterprise space himself.
okay.
Um, Other incubators are like IDEX. Yeah, there's a bunch. I can send you links. In terms of specific funds for healthcare, I'm aware of only one right now, which is a US-based fund which is only making investments in healthcare. Two actually. So there's Khosla Labs, of course, and there's Round Glass Partners, which are
Okay.
primarily healthcare focused. Yeah.
Okay. And regarding the government grants, you have given the name of Vivek, right? Who?
No, Vikram, who's on
Vikram, sorry. Sorry.
Yeah, Nikram. So,
Nikram. Oh, so I thought Vikram, sorry.
oh, it's Nikram. So you can go on the like a Department of Biotechnology under the Ministry of Science and Technology.
Okay.
So they come up with some grant proposals. So if you go on their website, they have a proposals rollover around the year, and they do a technology transfer. Sometimes they do Indo-US grant technology transfer.
Okay. And is the
This
process like more cumbersome and like lengthier
you
since it
check
is
on
a
the
like
website.
okay.
Yeah.
Okay.
Okay. Any more question? We're almost at 9 o'clock here in India.
Okay, Manas, maybe you can wind up.
Yeah, sure. Like there are no more questions, so we can wind up now.
Okay.
Thanks a lot for the session, Sanjana. This was
Thank you.
really
My
very
pleasure.
informative.
Thank you.
Thanks
So,
a lot, Sanjana.
thank you for having me. So most of you have my email address, but if I just put it in, I will send Manas a summary of everything discussed today, which will hopefully make it easier. But feel free to reach out to any of us, myself or any of the shapers, if we can help with anything.
So yeah. So I've sent the link. You can click right now. They have still an ongoing proposal submission. So they have deadlines. So similar like that. They have announcement on the website. So I've sent you the DVT link. And
Okay.
you can see there's a lot of proposals. The Indo-US, Indo-UK, and there's a lot of collaborations, technology transfer like that.
That's right.
So you can
Great.
just-
Thanks, Nikram.
Yeah, and they are medical device, so they're healthcare sector, right? So you can apply for that.
Yeah.
Okay.
Okay. Merry Christmas, everyone. Thank you.
Yeah, Merry Christmas. Thanks.
Right.
Thank you, everyone.
Thank you.
You.
Goodbye.
Goodbye.
Bye. Goodbye. Good night.